You think you know what investing is. You've read about it, maybe you've done a little of it, stocks, funds, returns, compounding. You have a rough model in your head. You study something, you decide it's worth more than the market thinks, you put money in, and if you're right, you grow. That model isn't wrong, it's just incomplete, because the closer people get to real capital, institutional capital, private capital, structural capital, the less investing looks like the thing you just described. It stops looking like research and returns. It starts looking like access, timing, relationships, and eventually something closer to architecture. This is what that transition actually looks like. 8 stages, 8 different versions of what investing means, and a question at the end that doesn't have a clean answer. You start at the bottom of a building you cannot see the top of. Your job is to understand numbers, not just read them, stress test them, rebuild them, challenge every assumption until you know exactly how fragile they are. A company says its revenue will grow at 12% annually. Your job is to ask, under what conditions? With what margins? What happens to valuation if that number is 8%? What happens if it's 4%? You spend months building financial models, discounted cash flow analyses, comparable company valuations, sensitivity tables that show how a single input can shift a conclusion by hundreds of millions of dollars. The work is precise, the hours are long, the output is a deck that someone more senior will use in a conversation you won't be in. What you think the job is, understanding value. What the job actually teaches you. Every number has assumptions behind it, and the assumptions are always a choice. You will carry that lesson for the rest of your career. Not because you became a great modeler, because you learned that the same set of facts can produce vastly different conclusions, depending on who builds the model and what they need it to say. That's the first thing proximity to capital teaches you. The numbers are not neutral. You get promoted, your compensation improves, and something changes that no one explicitly tells you. You start attending client meetings, you sit in rooms where companies are making decisions worth hundreds of millions of dollars, refinancing debt, exploring acquisitions, considering a sale. You are not there to speak. You are there to listen and to take notes, and to notice what actually drives these conversations. It is almost never the model. The model matters, but the decision to move forward almost always comes from something else. A relationship that's been maintained for a decade, a window of market timing that won't stay open long, the fact that one side of the table trusts the other side in a way that took years to build. The numbers justify the decision. They rarely create it. What you think the job is, executing transactions. What the job actually teaches you, deals are social structures built on trust and leverage, not just financial logic. You close a transaction. Your name does not appear in the announcement. That's fine. What you noticed is more valuable anyway. The moment the deal stopped being a negotiation and became inevitable, not when the numbers aligned, earlier than that, when the relationship decided. You are beginning to understand that finance has 2 layers. The visible layer is quantitative. The layer that moves capital is relational. Your title changes. Your responsibilities shift. You are no longer behind the room. You are in it, managing engagements, maintaining clients, generating new business, and something that was abstract becomes concrete. Reputation is a financial asset, not in a motivational poster sense, in a measurable, structural sense. The difference between a firm that gets called first on a major transaction and one that doesn't is almost entirely relational. Access, who returns your call, who includes you in a process, who trusts your judgment enough to share information before it's formal. That access is worth more than any single analysis you could produce. You start investing in relationships the way earlier in your career. You invested in models, deliberately, carefully, over long time horizons. What you think the job is, winning mandates and closing fees? What the job actually teaches you, access is scarce and it compounds. The information that moves through trusted relationships is qualitatively different from the information that's public. Not necessarily illegal, just earlier, more textured, more contextual. Someone who has spent 15 years building the right relationships sees a different version of the market than someone equally intelligent who hasn't. You start to notice this gap. You also start to notice that you're gradually crossing to one side of it. At some point, you stop advising and start owning. This is a fundamental shift. When you advised, your job was to represent a client's interests in a transaction. When you own, when you're part of a private equity firm or a direct investment structure, you are the capital. You make the decision. You take the position. You control the company. You sit on boards. You set strategy. You have in aggregate thousands of employees in the companies your fund holds, people whose jobs, benefits, and futures are connected to decisions you make in board calls and quarterly reviews. Most of those people you will never meet. Language starts to do something interesting here. The vocabulary of ownership is surprisingly clean. You talk about operational efficiency and portfolio optimization and right-sizing the cost structure. These phrases are precise. They are also heavily insulated from what they describe at the human level. What you think the job is, deploying capital and generating returns. What the job actually teaches you, ownership creates distance, and distance changes what decisions feel like. This is not a moral accusation. It is a structural observation. When you are responsible for a portfolio of companies, instead of a single relationship with a single client, the granularity of consequence changes. You are not indifferent. You are abstracted. That abstraction makes certain decisions easier to make. Whether that's a feature or a warning depends on how clearly you're willing to see it. You stop thinking in stories and start thinking in exposure. A single company is a story. A portfolio is a system. The questions you ask change. Instead of what is this company worth, you ask, what is our concentration in this sector? What's the correlation between these two positions in a stress scenario? Where are we overweight relative to our mandate? Individual outcomes matter less than pattern. You build mental frameworks for how different asset classes behave in different macroeconomic environments. You think about duration, liquidity, correlation. When one position moves against you, you're not reading it as a story about that company anymore. You're reading it as a signal about a broader dynamic. What you think the job is, managing risk and return across a set of assets. What the job actually teaches you. Scale changes perception. The further out you zoom, the more individual things disappear into trend. A company with 2,000 employees is a line item on a portfolio exposure board. That's not cruelty. It's the natural consequence of scale. But it is worth knowing that this is what happens to your perception when capital accumulates. The portfolio points outward, and you start watching systems instead of assets. Interest rates, currency dynamics, central bank policy, sovereign debt cycles, capital flow patterns between markets. At this level, you're not asking whether a specific company is well run. You're asking whether the environment in which all companies operate is shifting, and in which direction. You build macro theses. You take positions on currencies, on rates, on volatility that are not about any individual business. They are bets on the direction of entire systems. You have to be right about things that governments and central banks are actively trying to control. What you think the job is? Reading macro signals and positioning ahead of them. What the job actually teaches you. Markets are not just measuring instruments. They are pressure systems, and pressure builds before it releases. The people operating at this level see stress accumulate before it becomes news. Not because they have illegal access to information, because they have enough experience reading structural signals to recognize a pattern that's forming. The timing gap between what they see and what becomes public can be months. That gap is not a conspiracy. It is expertise at its most concentrated, but it is also where the line between insight, access, and structural advantage becomes genuinely hard to explain from the outside. You are no longer managing a fund. You are allocating capital at the institutional level, the level where decisions don't just reflect market conditions, they help shape them. Sovereign wealth funds, pension allocators, multi-hundred billion-dollar endowments. At this scale, the question is not what should we buy? The question is, how should we be positioned across the entire global system of investable assets? And what does that positioning do to the markets we enter? When an institution of this size changes its emerging market allocation, bond markets move. When it signals an interest in infrastructure, governments take notice. The capital is no longer just responding to the world. The world is partly responding to the capital. You have relationships with finance ministers, not because you sought political influence, but because at this scale, capital and policy are structurally adjacent. They overlap, they inform each other. The people running large sovereign allocations are functionally part of the infrastructure of international finance. What you think the job is, allocating capital responsibly across global markets. What the job actually teaches you, at sufficient scale, capital allocation is a form of power, not a metaphor for it. None of this requires anything improper. The power is structural. It comes from scale, coordination, and the simple fact that large capital flows have consequences that small ones don't. You start to understand why institutions like Temasek, the Norwegian Government Pension Fund, or the Qatar Investment Authority are studied not just as investment vehicles, but as geopolitical instruments, because that's what they become, whether or not they intend to. The final stage doesn't have a clean title. You don't have a role exactly, you have a structure. Your capital exists through a constellation of entities, holding companies, limited partnership interests, mandates extended to other managers, trusts, positions in financial institutions that themselves control positions in other things. The architecture is layered. Some of it is visible, much of it is not because it is hidden, but because complexity at sufficient scale naturally becomes opaque. You are technically a private individual. You have not executed a trade yourself in years. You make decisions, other people act on them. The decisions are not about specific assets anymore. They are about frameworks, which categories of risk to hold, which relationships to preserve, which mandates to extend or withdraw. What you think the job is, there is no job description at this level. What the job actually teaches you, ownership can become so indirect, so mediated through structure, that the concept of investor stops being accurate. The right word might be architect. The architecture does not need you to be visible to keep working. Capital, once it reaches sufficient scale and structural embedding, develops a kind of momentum. It continues because the structure around it continues. And that is perhaps the sharpest edge of the whole progression. You started by trying to understand the value of things, and somewhere along the way, the question quietly shifted. It stopped being about value. It became about structure. Who controls the flow? Who sets the conditions? Who designs the environment that everything else moves inside? Most people who start this journey are thinking about returns, and that's a reasonable place to start. But the people who move furthest along it will tell you, if they're being precise, that returns are almost a byproduct. What the journey actually produces is a particular way of seeing every system as a set of incentives, every relationship as a form of leverage, every market as a pressure structure, waiting for a release point. That's a powerful lens. It is also one that, applied long enough, changes what you notice and what you stop noticing. Not because the people at the top of this structure are exceptional or corrupt or different, but because any lens used exclusively for long enough starts to shape what you can see. The question worth sitting with is not how far up this structure you want to travel. The question is what kind of person you become when every decision you make is filtered through capital. There's no answer that applies to everyone, but it's worth knowing the question exists and knowing it early, while the model is still just a model and the numbers still feel like truth.